Hello everybody, this is Luqman Rafiq. Welcome to this P7 revision session. The 5-day session which comprises of a 15-hour total session, we would inshallah be covering majority areas of the P7 syllabus, and we would actually be focusing upon the various areas which could lead to the passes in the exam. To start off, I would actually like to give my own introduction. Myself, Luqman Rafiq, and I am actually serving as a CEO of Scriber College of Advanced Studies. It is one of the gold-rated ALP based in Karachi, Sakhar and Rawalpindi, 3 cities of Pakistan. We have got campuses in 3 cities of Pakistan. And I've been teaching since last 9 years, and my areas of expertise have mainly been financial reporting and audit. And over the period of these 9 years, I've been teaching various qualifications, which include the qualification of ACCA, ICAW, the Chartered Accountancy of Pakistan, which is ICAP, and the CIMA qualification. These are the various qualifications that I have mainly been teaching. So when it comes to the paper P7, I've been teaching P7 for some time now. It's been more than 3-4 years that I've been teaching this P7 paper, and I've also been teaching the auditing at the ICAW level and the ICAP, which is the Institute of Chartered Accountants of Pakistan. I've been teaching at ICAP level also. So before we move on, I would like to have a quick recall of the overall introduction of the paper P7 because I think a lot of you I don't exactly know the overall background that how many of you are going to attempt this paper for the first time, but I'm sure there would be some first timers. So in order to cover up, I'm gonna just discuss about the overall paper structure, and once we are done with the paper structure, then what we are going to do is that then we are going to move forward and we are going to start discussing about the other things. You would have received the various handouts, and these handouts actually are in total 5 handouts, and you would have also received this presentation slide which I have been using. If I talk about the paper P7, when you look at the syllabus of P7, you would find this specific diagram, this specific flow chart at the P7 first page of the syllabus. Now what exactly does this diagram indicates? Whenever we talk about auditing as a profession, so we need to understand this thing, that what exactly are we auditing? We are auditing the financial statements of an entity. And when we are auditing the financial statements of an entity, so that means we should know that how the financial statements are prepared. So in order to be an auditor, you need to know the accounting. Without accounting, you can't audit, because the financial statements is all about accounting and reporting. So that's why ACCA has also given a connection between this paper P2 and paper P7, that the P7 actually builds upon the basic what we had discussed at F8 level, and furthermore the paper P2 complements to this, the knowledge of paper P2 complements to this paper P7. So if you have to attempt P7, you need to know the accounting, and you need to know the accounting. Without accounting, you can't actually perform the audit. Over a period of time, the ACCA examiners reports, the reports that have been published by the examiners, those reports have always been indicating this thing, that the major reason for the students failing the exam has been the poor reporting knowledge. So I personally understand that if somebody wants to attempt this paper P7, so in order to be able to pass this P7, you need to have the good accounting knowledge, because it's not just about the auditing knowledge, it's about having an accounting knowledge also. So the important thing is, all of you who are going to be attempting P7 in this September exam sessions, my suggestion to all of you would be that you need to have a quick recall of the accounting standards that you have studied at F7 level, that you have studied at P2 level. So because once you recall those accounting standards, attempting the audit paper becomes a very easy task for you. So that's the first thing that we discussed about this P7, that you need to be able to understand this relation between P7 and P2. The second thing is about the overall syllabus structure, that how exactly is the P7 syllabus designed. You could actually see from this diagram that you could actually see that there are actually section A to section G for the P7 syllabus. Which in total is 7 sections in the syllabus, so it's in total 7 sections. Now if I talk about these 7 sections in this syllabus, so what I'm actually going to talk about is I'm going to discuss that which sections are there and how exactly is the paper examined. So you see there are actually, you could see that there are these 3 sections, which is the regulatory environment, section A, then the professional and ethical consideration, which is about section B, and then there is this practice management, which is about section C. So when we talk about P7, so what actually happens is these 3 sections are usually examined in tandem. They are examined together. You come across exam questions where there is not much of a segregation that you could have specifically identified that this question pertains to section A, or this question pertains to section B, or this question pertains to section C. It's usually a mixture of A, B, and C that one question is usually examined. The second section is basically this section D, which is the audit of historical financial information. And if I talk about section D, the audit of historical financial information, this section is one of the most important section for the paper P7. Anyone who fails paper P7 is because he is weak at this section D. So the section D has the same significance as we have got the group accounts in the paper P2, where the paper P2 you cannot pass the P2 if you are not good at consolidation. The same goes for paper P7 also. The paper P7 is actually all about section D, because section D, from the exam perspective, section D is around 45% of the paper. So this section D constitutes around 45% of the paper that you are being given examination question, which is 45, or at times it's about 50% also. So that's how it is. Now let's move forward. So section A, B, C is done. Then there is this section D, and then there is this section E. When we talk about section E as the syllabus area, so what comes into section E? Section E is something that is not examined in detail at F8 level. This is an area which is very new for the P7 students and a regularly examined area. In the section E, we talk about the various types of engagements, like review engagements and other assurance engagements. So we talk about the various type of engagements when it comes to section E. Section F, then again a very important section, talks about the audit reporting. So section F is then again an area which has a significance in the examination. Many a times you would find a specific question on section F, or at times you'll find a question on section F and with some areas from section D also. So overall in total, if I say that what exactly is the exam structure, so paper P7 you have got section A, and that section A comprises of 2 questions. And what are the 2 questions on section A? One of the question is basically question number 1, which is usually 35 mark question. Then there is this question number 2, which is usually a 20 mark question, section A question 2. Not 20, it's 25 mark question. And then if we talk about it, so this is in total 60 marks. Majority of the cases, what is actually happening is the examiner tests section A in this question number 1, section D in this question number 1, and for the question number 2, the area that the examiner covers is at times the question could be from section D, at times the question could actually be from section F, or at times the section could be a combination of section A, B, C. So it's not certain, but question number 1 is certain that you will be tested from section D of the syllabus. So this constitutes the 60 marks area of the syllabus, which is question 1 and question 2. And the next section is basically this section B, where you have to attempt the 2 questions out of 3. When it comes to section B, so in the section B you have to attempt 2 questions out of 3 questions. And each question is actually worth 20 marks each. So generally what happens is there is no area in paper P7 which is not examined. I mean, you come across a question from almost every single section of the paper. And at times at times what happens is that this section A is filled up with this entire section D, and then you have got question from other sections in section B. So you've got one choice which is only a 20-mark question, otherwise all is mandatory. So this is generally a structure of the paper P7. If I move further, if I proceed further, so I'm going to talk about detailed syllabus of the paper P7, that what exactly is the detailed syllabus structure. You could see from section A, B, and C. It's more about the laws and regulations that govern the auditing profession. It's more about the ethics, which we have already studied at the paper P1, at the paper F8. So it's more about the ethics, but at the same time, the ethics are more of a practical nature at this P7 level. And then you've got this practice management area, which actually covers up that how an audit firm would practice, how an audit firm would actually operate. So that is covered up by section C of the syllabus. So section A, B, and C, as I told earlier, that they are examined in tandem. They are not examined separately. Then there is this section D of the syllabus, which is audit of historical financial information, and I discussed this thing that section D is one of the most important area of the entire syllabus. And if you could actually have a quick look at this section D of the syllabus in detail. So the section D of the syllabus also, it covers up this planning, materiality, and assessing of risk of material misstatement. There's an area which is a new area to all of the students who have studied only F8, the group audit area. We do study consolidation in detail at P2 level. So the entire consolidation is actually, the entire knowledge of the consolidation is applicable and is examined through a group audit scenario. So all of the consolidation knowledge, whether that pertains to step acquisition, whether that pertains to group disposal, whatever area it pertains to, entire consolidation knowledge is examinable at this stage. The next is about the other assignments. Other assignments include various types of things, could be the prospective financial information, forensic audit, etc. So we will actually cover up that area also. And then there is this thing which is actually about is the voice is still echoing? Okay, to the questions, no. Okay, to the questions which have been asked here, this whole, are we going to go through the whole complete course? The answer is, I would try my best to go through the entire course to touch every single area of the syllabus. The second thing is, will this webinar be available offline? I don't have an idea. I'll just ask my organizer to actually respond to you. For the Tuesday and the Thursday webinar, can you get recordings? I think they do have a solution that if you are unable to attend and if you have already registered, you can get the webinar offline also. I think this is how it is. Okay. Anyways, so then we have got this current issues. So in fact, we were on to this syllabus, section E of the syllabus. So we talked about section E. Then the audit reporting area, very hot area, because there have been some changes. There have been some changes for the last 1 year in the audit reporting, and the changes have, in fact, not for the last 1 year, for the last 2 attempts. And the changes have not been dealt with in a very good manner by the students. So you could expect that the examiner testing the audit reporting on a regular basis and probably referring to the key audit matter section area of the syllabus of this ISO 700 key audit matter, he will probably be referring towards this specific area. Lastly, there are a few current issues and developments. In fact, not few, there are a lot of current issues. There are a lot of developments that have been happening at the P7 front, at the audit front, so they are also examinable. I'm not actually going to be covering them in details, but the other areas of the syllabus I will be covering in detail. For few of you, I did mention about accounting standards being very important for this paper P7. What I'm actually going to do is that I've actually shared a file with you people which covers up the examinable documents of paper F7 and paper P2. So at times those students who have got an ambiguity that which accounting standards could be examined at this which accounting standard could be examined or which won't be examined. So the answer to you people is that the F7 and P2 paper, you have got a list of examinable documents, and all of those examinable documents are examinable at this P7. You could actually see the change. Those of you who would have attempted the paper in this June examination, in the June examination, what had actually happened was we okay, in the June examination, if you could actually see this area, you could see this area that there is this IS 16, and after IS 16 we have got IS 19. There is no mention of IS 18. Now what does this indicate? This actually indicates that IS 18 is no more examinable. So that means the students will need to have knowledge of IFRS 15, which is the revenue from contracts with customer. So you'll have to have the knowledge of IFRS 15, which is revenue from contracts with customer, because this is what is going to be applicable to the P7 exam now. And at the same time, there is no IS 17 applicable, so you will have to have the knowledge of IFRS 16 leases. So you will have to have the knowledge of IFRS 16 leases. So these are the two accounting standards that have been added up. Otherwise, the entire accounting standard thing remains the same. IS 41 is an area which generally the students of P7 don't know much about. The examiner hasn't actually focused upon IS 41 during his P7 exam much, but he can actually focus upon it. So you could probably look into IS 41 also. Okay, so we move forward. So I talked about this, the various accounting standards that are examinable. Now let's move forward and let's just discuss further. So this is the overall syllabus overview, and we are now going to move on, and we are going to discuss about, we are going to actually start discussing about the syllabus. This first class, this first session, where we are going to be discussing about the audit overview, what I'm going to try to do is that I'm going to create an overall picture of the audit, that how does the audit actually operates, what are the various steps of the audit. Once we have gone through the various steps of the audit, then we will start discussing every single step in detail. So I personally think that this is very important for you to understand the overall audit overview, that how does the audit actually operates. So if I talk about how the audit actually operates, so I've actually mentioned about this tendering for the audit as the first step for any audit. Now, what do we mean by tendering for the audit as the first step for any audit? I'll talk about it. You see, when does the auditor comes into play? The auditor actually comes into play when a client wants to appoint an auditor. When the client wants to appoint an auditor, and the client actually seeks a quotation from you as an auditor, that we would want you to perform the audit of our firm or our company, and we would want a quotation from your side. So what actually happens is that we should not act as if, oh, we have been approached by somebody to perform an audit, so we should actually immediately give a quotation, because as many clients as we can have, this is going to be good for our firm. No, you don't have to do it this way. You're a professional accountant. You need to make sure that before you tender for the audit, before you give a quotation for any specific audit, you need to consider the various aspects. And what are those various aspects which you actually need to consider? You need to consider the various aspects, which includes that you need to consider the various ethical issues, various legal issues, commercial issues, and the professional issues. These are the various issues that you need to consider before you go ahead in giving a quotation or in bidding for a specific audit. Like for example, we would actually it at a later stage also, but if you are being approached by a client to give a quotation for the audit work, so you need to actually see that that there are no ethical issues. Like for example, there could actually be a situation that you might come across a self-review threat. How self-review threat? You have been providing the accountancy solution to that company, and now the company has actually approached you for the audit. So if the company has approached you for the audit, so you can't actually go to perform the audit, because this would lead to a self-review threat unless and until you are able to avoid this self-review threat by applying the appropriate safeguards. So you see, whenever you are being approached to perform the audit, you need to first see that whether we should bid for the audit, we should tender for the audit or not. And in order to see that, the first thing is ethical issues. Are there any ethical issues in us going forward? Number one. Number two is actually about legal issues. Now, what do you mean by legal issues? When I talk about legal issues actually means that at times what happens is you may be an ACCA qualified accountant. You might actually hold a qualification of any other body. So you see, if you are based in, let's say, if you are based in Middle East, and if you are based in Middle East and there is a specific regulation that in order to perform the audit of the companies above a specific paid up capital, you need to be, let's say, ICW qualified, or you need to have some other qualification, and if you think that you're not eligible for that, then you should not actually tender for the audit. So you need to consider the legal issues also, that are we legally eligible or not? Are we legally allowed to undertake this audit or not? The third one of them is actually the commercial issue. And what is this commercial issue? When we talk about the commercial issue, so you see, the audit quality should never go down, because if the audit quality goes down, then what happens is if the audit quality goes down, then ultimately your opinion might not be an appropriate opinion. You might actually end up giving a wrong opinion or an incorrect opinion. So there has to be a commercial incentive. So if there has to be a commercial incentive, you need to consider that, is this client going to give us appropriate commercial reward that we undertake this audit? And lastly, the professional issues, that considering that if the client's reputation is not good, so if there is a client whose reputation is not good, and if you actually bid for the audit of that client, that means you will be associated with that client as an auditor. Now, if you will be associated with that client as an auditor, that would actually probably harm your reputation, and you need to consider that should we go ahead with that client or not. So whenever we are being approached by any client to tender for the audit, the first thing that we need to do is that we need to consider that there should be no ethical, no legal, no commercial, and no professional issues. Number one. Okay. So the first stage is you tender for the audit. Once you have tendered for the audit, and once the client has accepted your quotation, the next step is actually signing of engagement letter, which is generally covered by ISA 210. Now, what is the significance of having an engagement letter signed? You see, whenever you have actually, though you might have mentioned a lot of things in the original quotation, you might have mentioned a lot of things, but that does not actually mean that that's a final agreement. The client might have actually argued on few things. You might have actually argued on few things. There could be a lot of things which might not be clear in that tender document. So it's very important that once your quotation has been accepted, so you get an engagement letter signed with the client. And when we get an engagement letter signed by the client, so ISA 210 specifically prescribes a format for the engagement letter, which covers up the various areas, including the scope of work, whether it is going to be an audit, or is it going to be a review, or is it going to be some other engagement. And the second thing is that what exactly is it going to cover? Is it going to cover the individual company financial, or is it going to be covering the group financial statements, or is it only going to be covering a specific area of the financial statement? It actually has to be defined very clearly. The next thing is actually the timings, the various procedures, which could include the inventory count, cash count, or other, even the audit deadlines. Okay, the next area is actually about the timings. When we talk about the timings, so there have to be various things, like the client might have set a deadline, and the deadline could actually be that you need to get over with the audit by a specific date, or there could actually be few things with respect to the specific client that you might have to perform cash count, inventory count on a specific date, etc. Then the third one of them is an important thing, which is a form of opinion, that what type of opinion or what type of report is it going to be. You see, what happens is generally ACCA has a specific format, but the format for the audit report differs from country to country, because it is actually dependent upon the country in which you are operating, that what sort of opinion will you be giving. So it's very important that in order to avoid any last minute surprises, you should actually include the type or the format or the type of opinion in the original engagement letter. Then the other terms and condition, and those other terms and condition could actually be, when we talk about the other terms and condition, the other terms and conditions could be the amount of money that you would actually be charging, and the other out-of-pocket expenses, and the miscellaneous expenses, and the timings when the money would actually be paid. These all things need to be discussed in the engagement letter. So up till now, what we have discussed is how the audit progresses. The first thing is you are being invited to tender for the audit. You tendered for the audit, and once you have tendered for the audit, you considered these 4 issues. And once your quotation has been accepted, the next thing is you have an engagement letter signed. And when we talk about getting an engagement letter signed, the engagement letter is going to cover up all these specific areas. So the next step is actually when you move further with the audit. So the next step is about the audit planning. And what exactly is this audit planning all about? So I'm going to discuss this audit planning. That audit planning stage is, what is audit planning stage? So if I talk about this audit planning, so the audit planning actually is, the third stage is when you are being appointed as an auditor, you start planning for the audit. And when we talk about starting to plan for the audit, so there are a lot of things which we need to consider while planning for the audit. And what exactly are those things which we need to consider while planning for the audit? So it has to be the overall audit strategy. The first one of them is the overall audit strategy that we need to consider. Now, what do we mean by the overall audit strategy that we need to consider? The audit strategy includes a lot of things. It actually includes that how exactly would we be initiating or undertaking this audit, and this could include the complete planning, which is what sort of resources would we be needing, how many juniors for this specific audit, how many seniors, how many experts. All of these things actually need to be considered. So as an auditor, you need to consider this thing, number one, that what are going to be the resources which you would be needing for this specific audit. And at the same time, in addition to the resources, would we be needing the work of an expert? Will we be needing an expert? Because there are at times various audits where there is a very technical work involved, and as an auditor, you cannot actually deal with those things. So it's always good to have an expert on board. So you will have to see whether you can actually have an expert on board or not. So this is also going to be one of the important things. The next thing is going to be, so this planning stage would include the overall setting out the overall audit strategy, planning out that what procedures need to be performed when, how the overall audit would progress, etc. These are the things that need to be considered. And at the same time, what we do at this planning stage is we perform these 3 very important acts. And what are these 3 very important acts? Which is understanding of entity and its environment, assessing the risk of material misstatement, and then at the same time planning out the responses towards the risk. So this is actually more of an application of ACCA 315, and this is the application of ACCA 330. These are the applications of the various ACCAs which are actually applied at this planning stage, and they are a very important ACCA with respect to the audit. So we have discussed about it, that how the overall audit progresses. You tender for it, the tender is accepted, you get the engagement letter signed. Once the engagement letter is signed, you start planning for the audit, and planning for the audit includes setting out the overall audit strategy. Planning for the audit includes understanding of the entity and its environment, that what exactly the entity does, how it operates, what is its internal environment, what is its external environment, etc. Then at the same time you need to assess the risk of material misstatements, that what exactly are the risk of material misstatement that exists in this risk, and then we plan out the responses towards those risks, that how exactly are we going to react or respond towards those risks. So this is actually one of them. The next stage is the performance stage of the audit. So once you have planned for the audit, then you move forward and you perform the various audit procedures. Why? What exactly is the objective? Because we have to gather the audit evidence. Why do we have to gather the audit evidence? Because we need to gather the audit evidence so that we can actually proceed towards the finalization stage of the audit and towards ultimately issuing the audit report. So you see, the way audit progresses is you need to plan out for the audit. Once you have planned for the audit, the next step is performance stage, where we perform the various audit procedure in order to be able to gather the audit evidence. And once we have gathered the audit evidence, then what we do is that then the next step actually moves into the finalization of the audit. And what actually happens at the finalization stage is your partner or your senior manager or your manager actually reviews the working paper for this client. And when they review the working paper for this client, so they actually try to figure out that has there been sufficient and appropriate audit evidence that has been gathered? Has there been sufficient and appropriate audit evidence that has been gathered? If yes, then they go towards the audit reporting, then they go towards concluding this specific audit. And if no, then they go towards performing the additional audit procedure. Like for example, if the partner feels or the manager feels that sufficient and appropriate audit evidence has not been gathered, then what exactly are they gonna do? They are gonna ask the auditor to perform the additional audit procedure and gather more evidence so they could actually conclude in a proper manner. So once this has been finalized, or once this has been reviewed by the partner or the senior manager, the last stage is about the reporting for the audit. And what is this reporting stage of the audit? When we talk about the reporting stage of the audit, so you do know from your F8, from your prior studies, that there are various types of the audit opinion that we could form. And the various types of audit opinion includes an unmodified opinion, includes a qualified opinion, includes an adverse opinion, or it could actually include an adverse disclaimer of opinion. So the various types of audit opinion that could exist include the unmodified, include the qualified, include adverse, and includes the disclaimer of opinion. So this is actually how it operates. So this is the finalizing stage, that once they feel that the sufficient and appropriate audit evidence has been obtained, so they go towards the reporting. Now this is the overall audit overview. That is, you tender for it, and once you have tendered for it, then you get the engagement letter signed, and the engagement letter is signed, then the next step is actually the planning stage. And once you have planned for the audit, then you perform the audit, and once you have performed the audit, then the finalization or the review stage arises, and once the review has been done, so the reporting stage actually arises. This is how the overall audit operates. This is how the overall audit functions. So we have set out the overall audit overview, and the next step that we are going to do is that we are going to look into each and every area into detail, that what exactly do we perform, what exactly do we do at these various areas. So the first area that I am going to move on to, in fact I'm going to answer the queries from the various people, and then I will actually talk about it. Atisham, there is a question from your side that can we pass this P7 by attempting 2 questions from section A and only 1 question from section B due to time limitations. When you attempt the entire paper, when you attempt a complete paper, then you enhance your chances of passing the paper, because what happens is even if you have attempted 2 questions which is 60 marks, you've attempted 1 question which is 20 marks, makes it 80 marks. So you need to understand that the 80 mark paper that you would have attempted, it's not necessary that that paper would be correctly attempted. So you should try and manage the time, because it's not something that's impossible. It's a possible paper. You can attempt it within 3 hours. Okay, do we have to study the standards thoroughly in P2 and F7? No, you don't have to do it, but you should have an overall overview of every single accounting standard that we operate that is actually applicable. You should have at least an idea, and I could actually give you an idea that what are the things that you should consider. One of the important things that you should consider is the recognition criteria, and at the same time, in addition to the recognition criteria, you could understand the various initial measurements, subsequent measurements, and derecognition and disclosure. These are the things that you should know about every single accounting standard. Azhar Khan, we will get back to you when we attempt the questions. You will get your answer. Do we need to read the book? I mean, it's entirely up to you. If you need to read the book, if you've got time, you should read. If you don't have time, then obviously you'll have to adopt for the shortcut methods of doing it. What is the difference between engagement partner and managing partner? Obviously, the engagement partner is the one who is looking after that specific engagement, and the managing partner could be a terminology that could be used to basically the firm's main partner or the senior partner. Can you recommend a guaranteed way of preparation to pass P7? Wali, what I could actually suggest to you is that you attend this session, and at the end of the session you would have actually been able to achieve a lot. You will be able to, you would have developed a lot of exam techniques. Yes, Saklan, I will give an overview. Azib, yes, you will be needing P2 knowledge, but obviously not that depth. But the P2 accounting standards are very much examinable at P7. Yes, Rida, you should download all the files. Hasan Khan, this is no rule that how many lines do we have to write for 1 marks, because what happens is 1 mark usually means 1 point, a valid point. A valid point could be expressed in 1 line, a valid point could be expressed in a short sentence, or it could be expressed in 5 lines also. Osama Ahmed, can you pass P7 without attempting P2? Yes, it is. I have seen a lot of people doing it. Whole paper and paper was not so difficult. I still don't understand why paper is not passed. Mashal, if you are unable to pass the paper, the best thing to do is actually check your the question that you have attempted, compare it with the examination marking scheme, and you will get an idea that how many mark scoring point you mentioned. Yasir Iqbal, you will get recorded form. Rafe, we are coming to materiality. Isha, no, you don't have to learn Aiza. Saad Masood, is it necessary to refer audit? No, Saad, it's not necessary. You would have seen the answers to the paper, and those answers are actually very, they are answers which are quite old. So you need to look at the revision kit for the updated thing. Do you have to write the ISO? Yes, mention accounting standard. No, you don't have to. Yes, there will be break. Well, SN Nawaba, you have asked that is that possible that report is modified but the report will be unqualified? Yes, it is very much possible that you give an unmodified opinion but you give an emphasis of matter paragraph, the report gets modified. Rohit, you don't have to write the number of the accounting standard. Manur, you can download it from the window. You could see the window there. You could download it from here. Asghar Khan Qasim, I appreciate your work. Please reply one of my query. Can IAS, IFRS and ISA number title is necessary to write? No, Qasim, this is not necessary. This is not necessary. Consolidation could be tested with respect to the application of the knowledge, like in the past they have tested foreign subsidiary, in the past they have tested a step acquisition, they have tested group disposal, and both scenarios in group disposal where the control is lost, where the control is retained, so they could examine it. I think I'll have to move forward because then I would not be able to cover up the area if I keep answering the question immediately right now. I would try to answer as soon as I get time. So Asad Ali, your answer, I failed 3 times and 49 marks, my knowledge is good. Asad, what I could do a favor to you is you could actually write one answer to one of the question and I can actually check it and revert it back to you and identify the weaknesses that you have performed, and we will be having the mock and probably pass it. So we are actually done with this overall audit overview, that what exactly is the audit all about. Now what I'm going to do is that I'm going to move on to the next area, which is about the audit planning. So let's just start off with the audit planning, that what exactly is the audit planning all about. So as I mentioned earlier, when we talk about the audit planning is actually covered up in the ISA series 300. So ISA series 300 covers up the entire audit planning, and the ISA 300, 315, 330, 320, they all cover up the various aspects of the planning stage of the audit. So what we are going to do is that we are going to cover them up one by one, and one by one we will cover them up and we'll go through it. Now first of all, when you are being appointed as an auditor, so what you do is that you start planning for that audit. And for you to start planning for that audit, as I mentioned earlier also, a very important step for you to plan for that audit is to devise an overall audit strategy, and that overall audit strategy could actually include developing a proper team for this audit. Now what do we mean by developing a team for this audit? You would have seen that a lot of people who work in an audit firm, the audit firm has got various sections. You could have one of the section which only has got clients from manufacturing sector, one of the sectors which have one of the sections which have got clients only from the financial sector. So you would have seen this thing that the firms at times insist that if somebody is from the financial sector, then the entire practice or the training period of 3 years, he stays in the same department. Why is that so? Because the firms, they see that we need experienced people. We need people like, for example, for the financial sector, if they have got a bank client, so they would prefer to have a person on that client who has already performed the audit of a bank. So it's very important when it comes to the overall audit strategy, because you do know that the audit will be performed on a test basis. The audit will be performed on a test basis. It is not going to be like that every single transaction will be tested for the audit. So it's very important that you have got a proper audit strategy. You've got a proper method of identification of the risk, and you've got a proper team, equipped team, which could handle the audit at its merit. So a very important aspect is to devise the team, which is that how many number of people will be needing on this team, and at the same time what sort of expertise should they possess, or what sort of experience should they possess, and will we be needing the work of an expert or not. So all of these things need to be planned at the first stage. Once you have planned at this stage, the next step is actually either 315, which constitutes a very big area at the planning stage. And when we talk about the either 315, so either 315 covers up 3 areas, which is number 1 about the understanding of the entity. The second one of them is the understanding of the environment of the entity, and assessing the risk of material misstatement. If I talk about what exactly is this understanding of the entity and its environment and assessing the risk of material misstatement, I'm going to talk about them one by one. You see, whenever you are performing the audit of a client, it's very important for you to be able to understand that what exactly the client does, what exactly is their business. So in our initial stages of the audit, we need to obtain the understanding of entity, and that understanding could include understanding the business structure. Like business structure could be that do they have got various branches, do they have got subsidiaries, do they have got any other related parties, what exactly is the business structure, how exactly is the business structured, the business is constituted, or the business is being conducted, number 1. The second thing is overall operating cycle, that where do they buy material from, whom do they sell it to, where do they buy, what exactly are the key components, what exactly are the key resources do they need for their specific business. So you need to understand the entire operating cycle, that how the business operates. Also, when understanding the entity, you also need to understand the supply chain, that where do they buy, whom do they sell, and how the raw material comes into their premises, how it goes into the manufacturing, how is it packaged, who packs it, who sells it, etc., etc. You need to understand the overall supply chain of the entity also. And a very key thing is to understand the changes in the entity during the year. Like changes in the entity during the year could be that 1 or 2 locations could be closed, or the changes could actually be you might have actually gone about disposing of a subsidiary, you might have actually gone or investing in a associate. There could be a lot of things that could happen. So the first thing that is actually going to happen is you need to understand the entity, that what the entity does, how it does, and have there been any changes in the entity or not, number 1. The number 2 thing is about the understanding of the environment of the entity. The number 2 thing is actually about understanding of entity's environment. When we talk about the entity's environment, so you see there are 2 things that we need to understand with respect to the entity's environment. That includes the external environment, and that includes the internal environment. Now, why is it important? You might actually have a question that why is it important for the audit to be able to understand the environment of the entity? You see, you are performing the audit of financial statements, and a lot of aspects, a lot of elements in the financial statements are being affected by the overall environment of the entity. Whatever is happening in the external environment of the entity, those things actually have an impact on the items reflected in the financial statement. So it's not just about entity, it's about understanding entity's environment also. And when we talk about the environment, so there are 2 things to it. Number 1 is the external environment of the entity. So you need to understand the external environment of the entity, which could actually be done through applying 2 of the models of paper P3. And one of the models is the pestle model, which is the political, economic, social, technological, ecological, and legal matters. And the other one of them is about the Porter five forces, which is about understanding of the bargaining powers of customers, competitive at the same time threats of new entrants and threats of the substitute products. So now I'm just going to give a brief hint of how this could actually have an effect on the audit. You see, let's assume that you're auditing a company which has invested heavily in its machinery, and the entity has got a very huge non-current asset balance. So the entity has got a very huge non-current asset balance. Now, if the company has a very high non-current asset balance, and what is happening in the operating environment is the number of customers have gone down significantly, and apparently there seems to be as such you don't actually see that the market would actually revitalize, or the market's demand, the product's demand would increase. Okay. Okay. Um, I'm sorry, there was some technical issue, and that's why, unfortunately, I think you people might not have been able to listen to me for a while. I'm going to resume from where we actually left. So, So you're talking about it that let's assume that the demand for the product has gone down, and you don't see that the demand is gonna go up in the near future. So when you see that the demand is not gonna go up in the near future, that means that is an indication that the entity's non-current asset might have been impaired. So now, if the entity's non-current asset might have been impaired, so what happens is IAS 36 requires that if there is any such indication, then you should test your assets for impairment. So basically, as an auditor, you should ensure that the entity has tested its assets for impairment. And when will you be able to do it? When you actually understand the entity's environment, when you know that what is happening in the entity's environment. If you don't know what is happening in the entity's environment, how will you understand that what exactly do you need to look out as an auditor? So very important thing is, when you understand the entity, you understand the entity and its environment. There was somebody who was asking that when are you going to start the exam question? I'm going to start the exam question in a while. I think it's going to take 10-15 minutes more to me to actually get through some areas, and then I'm going to move on to the exam question. Okay, so this is one thing which you need to understand the entity's environment. The second thing is that you need to understand entity's environment, and at the same time you need to understand the internal environment also. When we talk about understanding the internal environment of the entity actually means that you need to be able to understand that how good the control environment is, whether the internal controls have been in place or not, whether the proper strong internal controls have been made, whether the SOPs have been followed or the SOPs have been made. Because what happens is, all of these things help you determine that what should actually be the areas where you should focus upon. So this is what happens. You need to understand the entity, you need to understand its environment. And then the third one of them is assessing the risk of material misstatement. Now, very important thing is, what exactly is the risk of material misstatement? So when we talk about the risk of material misstatement, the risk of material misstatement is a risk that the financial statements are materially misstated. So when we talk about assessing the risk of material misstatement, so you need to understand that what exactly is the risk of material misstatement. It's a risk that financial statements are materially misstated. Now, when we talk about that the financial statements are materially misstated, so what exactly do we mean by that? First of all, when I talk about materiality, so the materiality actually is covered up in ACCA 320. And what does ACCA 320 talks about materiality? ACCA 320 says that materiality is a purely judgmental element. When we talk about materiality, it's purely judgmental. It actually depends upon the auditor, what auditor thinks to be material. So ACCA 320 does not prescribe any specific threshold of materiality that what should be considered as materiality. But practically speaking, we do know what is materiality. Practically speaking, and even the books actually give certain thresholds for the materiality, and those thresholds are usually 5% of the profit before tax. Those thresholds are 2% of the total assets. Those thresholds are 1% of the revenue. So these are the thresholds. So like for example, if you have got an item which is a profit and loss account item, you will compare it with the overall profit before tax and you will see whether it exceeds 5% mark or not. If you have got something which is a balance sheet item, you'll compare it with total assets. And if you've got a sales item, you'll compare probably with it with revenue. So the first thing is, you need to assess the risk of material misstatement. And what is the risk of material misstatement? The first thing is, when we talk about the material misstatement, it's a risk that financial statements are materially misstated. And what is materiality? So we did discuss about the materiality, that this is how materiality is judged in the quantitative basis. At times, the materiality is determined on a qualitative basis. Now you will say, what is qualitative basis? So at times the qualitative basis of ascertaining the materiality is, when we talk about ascertaining the materiality on a qualitative basis, so you see, let's say if there is a related party transaction, So when it comes to a related party transaction, in the related party transaction, even if the thresholds are not met, we will always think that such transactions are material. Why? Because those transactions could be subject to the management bias. So first important thing is, when we assess the risk of material misstatement, we need to understand that what is materiality. So we have actually discussed that. Now the second thing is misstatement. Now what exactly do we mean by misstatements? So when we talk about misstatement, the misstatement could be understood very easily, and that is, the misstatement is either when the financial statements are not prepared in accordance with the applicable accounting framework. Number one of them is when the financial statements are not prepared in accordance with the applicable accounting framework, number one. And number two is non-validity of assertion. Now, what do we mean by non-compliance with accounting framework or non-validity of assertion? So you see, as an auditor, when you go to perform an audit, the first objective is you are auditing the financial statement. You need to see if the financial statements have been prepared correctly or not. So if you need to see that the financial statements have been prepared correctly or not, so you need to first understand the accounting framework, that what does the accounting framework says. When you understand what the accounting framework says, then you can actually decide whether the financials have been prepared correctly or not. So the misstatement is that the financial statements have not been prepared in accordance with the applicable accounting framework. Now, what do we mean by applicable accounting framework? So if I discuss about it, I've given an example of IAS 16, property, plant, equipment. For any specific accounting standard, you would come across these 3-4 things. Number one is the recognition criteria. Number two is the measurement criteria, which includes initial and which includes the subsequent measurement. Number three is derecognition, and the fourth one of them is the disclosure. Every single accounting standard you will come across, you would come across these things. So now let's just talk about it. What is misstatement? Misstatement is non-compliance of accounting framework. Now, how would we not comply with the accounting framework? Number one thing is, IAS 16 says property, plant, equipment will be recognized when it is probable that future economic benefits will flow to entity, and at the same time costs can be measured reliably. At the same time, costs can be measured reliably. Now, if a property, plant and equipment does not meet the criteria, if a property, plant and equipment does not meet this recognition criteria, then it should not be recognized. So when we talk about the misstatement, what is misstatement and how could the misstatement arise? The misstatement could arise this way, that a property, plant and equipment does not meet the recognition criteria, but it is still recognized. That is, you were uncertain about future economic benefits. You were uncertain about the future economic benefits. And when you were uncertain about the future economic benefits, then you were like, we don't know whether the future economic benefits will arise or not, but still you recognize the asset. That means you have misstated the financials. You should not have recognized. Number two, IAS 16 says property, plant, equipment should initially be recognized at its cost. Now, what could be the misstatement? Misstatement could be that instead of recognizing it at cost, you recognize it at fair value. So if you have recognized the asset at fair value, IAS 16 never allows the property, plant, equipment to be initially recognized at fair value. That means you have misstated, you have deviated from the accounting framework. The cost includes certain elements in accordance with IAS 16, and one of the notable elements is the dismantling cost. Generally speaking, the entities make an error when they recognize this dismantling cost. So a company has recognized an asset, but it has failed to recognize the dismantling. So if it has failed to recognize the dismantling cost, that means the financial statements are misstated. Whether they are materially misstated or not, that's a decision that needs to be taken, but they are misstated. Next, when we talk about subsequent measurements, so IAS 16 says that Subsequently, the property, plant, equipment should be recorded either at cost model or the revaluation model. Now when we talk about it that the property, plant, equipment shall be recorded either using the cost model or the revaluation model, then IS 16 also states that entire class of asset shall be measured using the same model. Now where could the misstatement arise? The misstatement could actually arise with respect to the selective application. At times what the entities they do is that they don't recognize the whole class of asset on the same model. At times they selectively apply this model. Like for example, if an entity follows revaluation model for properties and it has got 10 properties in its balance sheet, then every single property needs to be carried using the revaluation model. And the last thing is derecognition criteria. At times you derecognize the asset when the derecognition criteria is not met. This is then again a problem. And then disclosure. Either you have not made any disclosure or you have made incomplete disclosure. So it could either be non-disclosure, it could either be incomplete disclosure. So the misstatement could actually be with respect to the non-compliance of accounting framework, number one, or it could be because of the non-validity of the assertions. Now what exactly are the audit assertions? So the audit assertions are actually the declarations by the management while preparing the financial statement. Whenever the management prepares financial statement, they are deemed to make certain declarations. And what are those declarations? Those declarations are termed as audit assertions. Generally speaking, what happens is, I remember these audit assertion using the mnemonic of C square compare. What is the C square compare? The C square compare could actually be referred to these things, which is the classification that the assets or the liabilities or the income or the expenses have been correctly classified. Completeness, which is that 100% of the transactions have been recorded. Okay, there are questions. A lot of people are asking that will we be okay? We will have namaz break in 10 minutes time. We will take namaz break at 7:20 p.m. So now next, we were talking about the assertions and what exactly are the assertions. The assertions are the declarations by the management whenever they are preparing the financial statement. So you could remember the assertion using this mnemonic of C square compare, which is classification as one of the assertion, which is that the assets have been classified as assets, the liabilities have been classified as liabilities, current assets have been classified as current assets, etc., etc. So that's number one. The number two thing is about completeness, that the 100% of the assets or the 100% of the liabilities or the income or the 100% of the expenses have been recorded. Then there is this cut off as the assertion, which actually means correct period. So the cut off means correct period, that we have recorded the expenses or we have recorded the income for the correct period. And what is this occurrence? Occurrence is transactions have taken place. Occurrence is transactions have taken place. The measurement assertion is that you've measured things correctly. The presentation is actually about the presentation and disclosure, which means that you claim that you have presented the financial correctly, which could actually be the balance sheet or the income statement, and at the same time you have given appropriate disclosure in the notes to the financials. The accuracy means correct transactions have been recorded accurately. There have been no mistakes in recording the transaction. The rights and obligation is we have rights to all the assets that we have shown. All the obligations that we have shown, we are liable to those things. And then existence, which is the assets physically exist. So now, when we talk about the risk of material misstatement, so the risk of material misstatement actually means that the risk that financial statements are materially misstated. And when we talk about the risk that financial statements are materially misstated, so I talked about it, what is materiality? And then I talked about misstatement being either non-compliance with accounting framework or non-validity of the assertion. And then I talked about it that how the accounting framework is being incorrectly applied and what could go wrong with the assertions. We will keep it till here right now, and we will have a break for namaz. For those people who have actually asked a question, I'm gonna answer the questions to Ayatisham, you are asking, is the new format of auditor's report examinable? Yes, it is examinable. Mohsin Salman, please cover the writing techniques. Yes, Mohsin, I will. I mean, this is not going to happen that I won't. I will cover them up. Notes are enough. Ahmad, we will practice. We will be very exam focused. Don't worry about it. Osama, yes, self-study you can pass. Rohit, please advise commercial acumen needed in Rohit, I do understand that the examiner is focusing upon very much real life scenarios, and this is becoming a problematic situation for a lot of students. But I guess more the exam practice, the better it is. Can we have a webinar group on WhatsApp for this session to discuss and make use? Anshul, yes, I will create a webinar. I will create a group, and probably I might actually send an invite over here. And Awais, failing at 49. I mean, it's very painful, but then again, there could be few things. Like if you try to complete the paper, you might actually be able to go through it. Mashal, yes, a bit of a standards will be given. Rabi, I'm starting them immediately after the break. Mohsin, you're right. We'll discuss the exam technique. Yes, Asghar, it does include it. Okas, it will start. Well, Pritika, yes, it is not that Hen, it's not final slide. We will attempt the exam questions now. We'll attempt the final exam questions now. So we can have a namaz break. Okay, welcome back everybody. Let's start off. We actually discussed before the break about the various things. Now let's start off, and what we are going to discuss is that we are going to start discussing about you have the exam questions with you. So what we will discuss is the first question that we will start discussing is question number 1 of December 2014. So the first question that we will start discussing is going to be question number 1, December 2014. The name of the question is Connolly Company. The name of the question is Connolly Company. So we will discuss this question. We will study with it. The first thing is whenever you come across a question in the exam, that how exactly should we deal with the question, a lot of the students actually inquire this thing, that how should we deal with the question. So I'm going to start discussing various things about a question, that how should you actually deal with it. Now you see, when we talk about this question, I'm going to go through this question together with you people. And for the future, we would actually leave it upon you people to discuss and to actually go through, and then we can discuss the answer. So the question says, you are an audit manager in Davies and Company responsible for the audit of Connolly Company, which is a listed company. You see, always highlight few important areas, which is a listed company operating in the pharmaceutical industry. Whenever we talk about the pharmaceutical industry, it's always a risky industry. You are planning the audit of the financials for the year ending 31st December 2014, and the audit partner Ali Stone has sent you this email. Now, what does the email says? The email says that I would like you to start planning the audit of Connolly Company. The company's finance director has sent to me this morning some key financial information discussed at the latest board meeting. I've also provided you with minutes of the meeting, etc., etc. Now, the first thing is evaluate the business risks that are being faced by the Connolly Company. So the question's first requirement is evaluate the business risks that are being faced by Connolly Company. What I'm going to do right now is I'm going to start discussing that what exactly do we do when the question says that evaluate the business risk, and how exactly do we answer the question. See, the first thing is, what exactly do we mean by business risk? Whenever we talk about a business risk, the business risk is the risk that an entity will not be able to achieve its objective. It's a risk that an entity will not achieve its objectives. Now, a lot of actually things could lead to an entity facing a business risk. When we talk about it is, let's say if I say there is a company which has got a high fixed cost. So high fixed cost is a business risk. Why? It could have an adverse impact upon the business. How it will have an adverse impact upon the business? Because when you've got a high fixed cost, that means in times of crisis, when the sales go down, then it becomes very difficult to fulfill the fixed cost. So at times you have this risk. An entity dealing with the foreign exchange actually faces a risk. Now, what risk do they face? That if there is an exchange rate movement which is an adverse movement, the entity will end up losing the money in it. Similarly, there could be a lot of things. At times you are operating in an environment which is a dynamic environment. So whenever you are operating in a dynamic environment, the dynamic environment always poses some risk. So the P7 examiner, he actually, every alternate attempt, if you see from the past trend, every alternate attempt, there is usually one question pertaining to this. Usually there is one question which is majorly pertaining to the business risk. So whenever the exam question says that evaluate the business risk, so what do you need to do? You need to understand that what is a business risk? A business risk is the risk that the entity will not be able to achieve its objective. And there could be multiple things which could actually prevent an entity from achieving the business risk. So if the question requirement says evaluate the business risk, if the question's requirement says evaluate the business risk, then how exactly do we need to write down the answer to it, that how do we evaluate the business risk? So the examiner is actually expecting you that you will first of all identify the risk. You will first of all identify the risk, and once you have identified the risk, then what you will do is that you will explain that why is it a risk. You will explain that why is it a risk. So the way examiner marks this whole thing is they usually give half a mark for identification of the risk, and they give one a mark for the detection, for the explanation that why exactly is it a risk. So you see, you come across a question, every single risk will lead to 1.5 marks. So if I talk about this question, which is December 14, question number 1, which is Connolly Company. It says evaluate the business risk faced by Connolly Company, and it's an 11 mark question. So if I say 11 mark question, so it's going to be 11 divided by 1.5 leads to approximately something like 7 risk. So you need to talk about 6 to 7 risk. That is something that you have to talk about. So you need to identify the risk. You'll get half a mark for it, and you will have to explain that why is it a risk, so you'll get 1 mark for it. So that's requirement number 1. Now let's move on to the next requirement. When we talk about the next requirement, the next requirement says identify and explain four risk of material misstatement to be considered in planning the audit, and it's a 8 mark requirement, which makes it very simple that it's going to be 2 marks per specific single thing. Then there is this questions requirement, recommend the principal audit procedures to be performed in respect of the acquired Coal Comfort brand name, and discuss the ethical issues. We have not covered up every single area of the syllabus right now, so what we are going to do is that we are going to focus upon few areas. We are going to focus upon business risk. We are going to focus upon the risk of material misstatement. That's what we are going to focus upon. So I would actually suggest you people to give a quick 4-5 minute reading to this question and try to identify the business risk that Connolly Company faces in this question. So you give a quick 4-5 minute, and then we'll start discussing. Mariam, the question is question number 1 of December 2014, and when you will actually look at the handouts in this webinar, you'll find the question. There are these 5 handouts, and amongst these 5 handouts there is this December 2014 question number 1. Okay, let's start off. We are going to start discussing about this question, which is December 14, question number 1. So the first thing is that the question's requirement is evaluate the business risk that are being faced by Connolly Company. If I talk about it, number 1 is Connolly Company is a pharmaceutical company developing drugs to be licensed for use around the world, and the products include medicines such as tablets and medical gels and creams. Now, some drugs are sold over the counter at pharmacy stores, while others can only be prescribed for use by a doctor. Products are heavily advertised to support the company's brand names. In some countries, television advertising is not allowed for prescription drugs. See, what is a business risk? A business risk is the risk that the entity will not be able to achieve its objective. If I try to identify the business risk in this given scenario, my business risk, number 1 business risk is going to be that advertising is banned. Advertising is banned in some countries, and we are actually heavily advertising in certain countries. So if we are actually advertising heavily in certain countries, then what will happen is that there could actually be a risk that if the advertising is banned in a certain country, and we might actually end up advertising in that country, then we might end up facing penalties and bans and etc. We might end up paying a lot of penalties. So that's one of the risks. Number two is that the market is very competitive, encouraging rapid product innovation. New products are continually in development and improvements are made to existing formulations. 4 new drugs are in the research and development phase. Drugs have to meet stringent regulatory requirements prior to being licensed for production and sale. Research and development involves human clinical trials, the results of which are scrutinized by the licensing authority. Now, if you try to identify this thing, the market is very competitive, encouraging rapid innovation. So I could actually see that this is also a risk, which is that market is rapidly changing market. It's a dynamic market. The market is actually changing rapidly. That is a business risk. You would say, why is it a business risk? See, it's a business risk because if we are unable to meet the pace of change, then what will happen? What is actually going to happen is that you will lose your competitive position. That is going to be an issue that will arise. So if we are unable to meet the pace of the change, we'll end up losing our competitive position. That's the second risk that is arising in this specific scenario. Now, what's the third thing? Now, if I move forward, then it says that the 4 new drugs are in the R&D phase. Drugs have to meet a stringent regulatory requirement, etc. It is common in the industry for patents to be acquired for new drugs, and patent rights are rigorously defended, sometimes resulting in legal action against potential infringement. So you see, we come across another risk, which is that in our industry, we have to face this thing, which is the patent infringement risk. So we need to face this risk, which is of the patent infringement. Now, what is going to be that risk? That risk is going to be that we might have developed a patent and somebody might end up claiming that this was a patent developed by us and not developed by you. So that is actually going to be a problem. So this patent infringement could be one of the risks that could lead to legal actions against the entity. Then the next step is Connolly has approached its bank to extend its borrowing facilities. An extension of 10 million is being sought to its existing loan to support the ongoing development of new drugs. Our firm has been asked by the bank to provide a guarantee in respect of this loan extension. Now you see, one more thing, which is if you see that the entity does not have sufficient cash available. So when the entity does not have sufficient cash available, then what will happen is the entity will not be able to invest heavily in the research and development, and the industry through which you belong actually requires rapid product development, rapid innovation. So this innovation would need funds, and the entity does not have the funds available. So that is actually one of the problem. That is a problem. So what is going to be the risk? The risk is that it will not be able to meet the funding wouldn't be available, and the result would be that the entity will not be able to continually develop, and resultingly then again it will lose out its market position. It says, in addition, the company has asked the bank to make cash of 3 million available in the event that an existing court case against the company is successful. The court case is being brought by an individual who suffered severe and debilitating side effects when participating in a clinical trial in 2013. So that is also one of the issues, which is we are fighting a court case. Now, when we are actually fighting a court case, that means that there is a risk. Now, what is that risk? The risk is about the poor reputation. The risk is about bad reputation amongst the market participants or amongst the consumers, that this entity does not take care of the human life, and the clinical trials are being done on humans, and this has resulted in severe debilitating side effects. So overall bad reputation would be caused because of this court case. And also, it's not just about the bad reputation, it's about the financial losses also. It's not that you will not have to bear any financial loss. The company has asked the bank $3 million to pay for this cash. So the financial loss would be borne by you. Resultingly, what would happen is, this is another thing that would have an adverse impact on the entity. This would have an adverse impact on your business. Now let's move forward. Let's just discuss further. So it says, in January 2014, Connolly began to sell into new market, that of animal health. This has been very successful, and the sales of vet pharmaceuticals and grooming products for livestock and pets amount to approximately 15% of total revenue. Now let's just try to understand this thing. We are talking about business risk. What is a business risk? Business risk is the risk that the entity will not be able to achieve its objectives. Now I'm going to try and explain one thing to you. The entity has started entering into the animal pharmaceuticals, and the venture has been successful. Now you see, what happens is, when we face difficulties on our existing business, and we try to enter into new markets, and if we get good response from that new market, then what happens is we end up losing focus on our existing business. Our existing business, we lose focus. At the same time, our existing clientele we neglect. The result is that the overall business goes down. So another business risk is that the senior management might lose focus. The senior management might lose focus. So senior management might lose focus. Next, another success in 2014 was the acquisition of cold comfort brand from rival company, etc. I don't see any business risk in it. It says Connolly's accounting and management information system are out of date. And the further thing that it says is that this is not considered to create any significant control deficiencies, but the company would like to develop and implement new systems next year, etc. The management has asked our firm to give advice on the new systems, as they have little specialist in-house knowledge. So apparently this is not something that could create some sort of business risk. Yes, but let's just have a look at few of the numbers, key finance information. You could see that the revenue has gone up, but the operating profit has gone down. So the operating margin has gone down. That means what is happening is poor cost control. Operating profit margin has gone down. This indicates poor cost control. This indicates poor cost control. What else? Then you have got a net cash outflow. Research and development outflow is there. The total assets are there. Anyways, apparently what we could figure out from this thing is that the company has a poor cash flow position, and the costs are increasing. Resultingly, the profits will go down. So this is also going to have an adverse impact, because automatically you already don't have much cash. You have to have cash available for the development, etc. and then if you will have lower profit margins, then you will have further issues with respect to cash flows. So these are the general business risks. Does anyone have any questions with respect to the business risk? Yeah, I mean, scrutiny by licensing authority is a risk. Compliance risk could also be there. Anyone has any other question with respect to this? Yes, the high stringent regulatory risk is also going to be there. Okay, Jazeb, I will amortization of brand is a risk. No, that actually pertains to financial statements. Walid, I did discuss about this, half a mark for identification, 1 mark for explanation. Yes, acquisition can be a risk, but you have acquired only a brand. You haven't acquired a whole company. Yes, Hein, it could be another risk. Well, it's not one client. It's actually about this segment has this 15%. It's not about one client. Yes, non-compliance could also be the risk. So yes, I think you people are pretty much getting it, that what exactly could be the risk. Somebody mentioned to me that I should rather try to write on this Word document rather than so I'll draft answer. Okay, I'm gonna write answer to one of the thing, and let's say one of the risk is rapidly changing environment. So what you will do is that you will write competitive position as one of the risks, and the way you would write down the answer to this question is that you will say the entity operates in an environment where it needs to develop products on a continuing basis there is a risk that if the entity is unable to produce drugs at a pace equal to that of competitors, then it might end up losing its competitive position. So you draft the answer this way, and it has to be very, very simple. It should not be very complicated. You should write to the point that what is the risk and why is it a risk. Which group, Motiur Rahman, which group? Okay, let's move forward. Let's just discuss further. So this is one area. Rabia, let's just let me see your question. Wali, you could actually identify which question you want me to attempt. So I would consider I might actually be attempting this question in 1 or 2 days also, because it's not just over. Rabi, ideally speaking, yes, heading of every point, and just you don't have to write down the bullet points. It has to be the short paragraph. It has to be the short paragraph. Let's move forward. Let's just discuss further. So we'll move forward with respect to this area. And we have got the next requirement of this question, and the next requirement of this question is identify and explain the 4 risks of material misstatement to be considered in planning the audit. So identify and explain 4 risks of material misstatement to be considered in planning the audit. Now, I have already explained to you people that what exactly is a risk of material misstatement. Now what you do is that you try to figure out the 4 risks of material misstatement. Now, I would actually share with you what the examiner has actually told in the past with respect to how students go about. What the students they do is that the examiner clearly specifies that you have to write down 4 risk of material misstatements. What the students they do is that they try to identify more and more risk. So it's not advisable, because ultimately you might end up getting good marks in this question, but you will lose marks in the other questions. Why? Because the time management won't be possible. So the preferable thing is that you should only write 4 risk of material misstatement if you are being asked for 4. You don't have to write 5. So let's just go ahead and try to identify the 4 risk of material misstatement that are to be considered in planning the audit for this specific scenario. Okay, now let's just start off with the 4 risk of material misstatement. So we did discuss that what exactly is the risk of material misstatement. The risk of material misstatement is the risk that the financial statements will be materially misstated. Now you need to understand one thing, that whenever we talk about the risk of material misstatement, so the business risk and the risk of material misstatement has a very strong connection. The business risk and the risk of material misstatement have got a very strong connection. Now, what exactly do we mean by having a very strong connection? So let's just try to understand. Example is, when we talk about business risk, so at times we say that an entity is dealing with foreign exchange. We say that the entity is dealing with foreign exchange. If the company is dealing with foreign exchange, so dealing with foreign exchange is a business risk. But it could actually lead to the risk of material misstatement. Now, what could be the risk of material misstatement in this foreign exchange? The risk of material misstatement could be that the entity does not comply with the provisions of IAS 21, which specifies that you need to follow a specific exchange rate, you need to use the specific date exchange rate, and you need to recognize the gain or loss in P&L, etc., etc. So what would happen is the business risk would lead to the risk of material misstatement. So at times when you are attempting a question where you have a requirement of business risk and also a requirement of risk of material misstatement, so you might actually try to identify that if we could connect any risk of material misstatement with the business risk. If that is possibility, then good enough. If that is not a possibility, then even then that is not an issue, because all that you need to think is that you need to identify that where the entity could make an error. So I am going to identify that what are the risk of material misstatement in this scenario. I'm going to discuss this question along with you people, because this is the first question, so I'm spending a lot of time onto this question, and the next question we won't be spending this much amount of time. So let's just talk about it. We'll discuss. You see, when it says material misstatement, so I told you that the misstatement is that the financial statements will not be in accordance with the IFRS, will not be in accordance with the accounting framework. So whenever we have to identify the misstatement, we have to think that what could go wrong in financial statement. Whenever the question's requirement says that identify the risk of material misstatement, so you need to think what could go wrong with the financial statement. You need to think that. Now see how. In this scenario, it says Connolly Pharmaceutical Company, the drugs to be licensed for use around the world. Products include medicines such as tablets, gels, etc., etc. The market is very competitive. New products are continually in development and drugs are made to existing formulation. 4 new drugs are in the research and development phase. You see, whenever the entity is performing the research and development, whenever the entity is actually having research and development, then the IAS 38 comes into play. And what does IAS 38 says? IAS 38 says the research related costs should be charged to expense in the P&L, and the development related costs should be recognized as an asset. That's what IAS 38 says. Now, whenever the question's requirement is identify the risk of material misstatement, so what is the risk of material misstatement? Is you need to think what could go wrong with financial. Now, what could go wrong with financial in this case? What could go wrong with financial in this case is that the entity might have capitalized the research cost. The entity might have capitalized the research cost. That is something that could go wrong with the financial statement. And the second criteria is IAS requires that the development cost shall be recognized as an asset, provided it meets the criteria for capitalization. So there could actually be another risk, which is that the development cost does not meet capitalization criteria. So you see, one of the risk of material misstatement in this scenario is that the entity might have capitalized the research costs instead of expensing them into the P&L. And the other one of them is that the development costs do not meet the capitalization criteria. Now let's move forward. It says it is common in the industry for the new drugs to be acquired and the patent rights are rigorously defended, sometimes resulting in legal action. Connolly has approached the bank to extend its borrowing facilities. Now let's come over here. Let's put it in your mind that whenever a company, whenever you come across a scenario where the company actually wants to obtain finance, so every company who wants to obtain finance would want to show a very good picture to the bank. So whenever we talk about it that the company wants to obtain finance, the company would want to show a very good picture to the bank. So generally speaking, if the entity is in need of finance, then it would try to have its financial statements window dressed. So the financial statement would be subject to the management bias. So what exactly is the risk of material misstatement? Meaning what could go wrong with the financial statement? What could go wrong with the financial statement is that since entity is applying for extending borrowing facilities, it might the financial statements may be subject to management bias. So the financial statements may be subject to the management bias. The next one of them, so you need to remember, if the company is going towards listing, then the financial could be subject to management bias. The company is going for extension of the borrowing facility, you need to think that the financial statements could be subject to management bias. Probably the profits might be overstated, revenues might be overstated, assets might be overstated. The next scenario is, in addition, the company has asked the bank to make cash of $3 million available in the event that an existing court case against the company is successful and the court case is being brought by an individual who suffered severe and debilitating side effects. You see, if somebody is claiming, if somebody has filed, if somebody has taken your entity to the court and you do know that the entity was at a mistake, so that means there is a highly likely chance that the entity will have to settle the liability. So now what should happen is that the accounting treatment should be that the entity should have recognized the provision for this payable. The entity should have recognized the provision for the court case. The entity should have recognized the provision for the court case. So if we talk about the entity should have recognized the provision for the court case, so what exactly is the risk of material misstatement? The risk of material misstatement is that the entity may not have recognized the provision. Entity may not have recognized provision, resulting in understatement of liability. So the entity may not have recognized the provision, resulting in understatement of liability. That's one of the risks. So the next is, in January 2014, Connolly began to sell into a new market, that of animal health. This has been very successful, and the sales of vet, pharma and grooming products for livestock and pets amount to approximately 15% of total revenue. Now I would like to actually draw your attention, as I said earlier at the start also, that in order to do the audit you should know accounting. So if you read in the first line of this question, you would figure out that this Connolly company is a listed company. You would figure out this thing. And there is an accounting standard which is called IFRS 8 operating segments. It applies to listed companies. And what does IFRS 8 say is, generally speaking, when the entity has multiple business segments, or multiple geographical location, then it is required to give a segmental disclosure in accordance with IFRS 8. So over here, if you see this company, It was in a normal human pharmaceutical, and the company then diversified into the animal health. So if the company then diversified into the animal health, that means if you try to see this, you would figure out that the company has actually entered into a different sector. So if the company has entered into a different sector, that means there are two separate segments, and now IFRS 8 operating segments should be applied onto this company's financial statement. So what is the risk? The risk is that segment disclosures in accordance with IFRS 8 is not provided. So the segment disclosure in accordance with IFRS 8 is not provided. That is one of the risks. Jahadev, I will draft it. Well, the segment reporting actually requires you to disclose. It's a disclosure-based accounting standard. IFRS 8 does not say anything. It's just about disclosure. So there is a risk that the IFRS 8 operating segment requirement with respect to the disclosure for the various operating segments is not being complied with, or even if it is complied with, then it is not properly reflected. That's what the audit risk is. Another one of them is, I'm just trying to, you need to be a bit patient. I'm just trying to explain to you people that how exactly you could, to what depth you could deal with the question. The next one is, another success in 2014 was the acquisition of Cold Comforts brand from rival company. Products to alleviate the symptoms of coughs and colds are sold under this brand. The brand cost 5 million and is being amortized over an estimated useful life of 15 years. Now you see, you need to think what could go wrong with the financial statements. If it says that the entity acquired the Cold Comfort brand name and it says that the brand cost 5 million and is being amortized over the estimated life of 15 years. Now when it says the brand is being amortized over the life of 15 years, what does this mean? So the brand is being amortized over the life of 15 years. This means that there is actually a risk that who actually told them that the brand would have a life of 15 years? The brand might have a life of 5 years. If the brand has a life of 5 years, that means 5 divided by 5 means $1 amortization to be charged every year. But you are charging 5 divided by 15. So what is the risk? The risk are there are two risks, and one of the risk is actually when it comes to this brand's amortization. So one of the risks that arises over here is with respect to the brand is, number one, that since it is acquired during the current year, then it should be amortized on time proportionate basis during the current year. It should be amortized on a time proportionate basis during the current year. So now what is the risk? The risk is that they have not amortized on time proportionate basis. They have not amortized on time proportionate basis. And another risk that could arise is the life of 15 years might be unreasonable. The life of 15 years might be unreasonable. Not really. IFRS name and number is not necessary. No, ROMM and business risk are not interchangeable. Business risk is purely pertaining to risk. ROMM is actually all about, when we talk about the risk of material misstatement, it's all about the financial statements. So if I actually draft one of the risk of material misstatement, if I draft one of the risk of material misstatement in this scenario, I would draft it this way. So the entity has acquired cold comfort brand name during the year and is amortizing it over 15 years period. There is a risk that the entity has not amortized it on a time proportionate basis in the current year and has instead amortized over the full year. There is a further risk that the estimate of 15 years is overstated, resulting in a reduced amortization charge in financial statements. So basically this is how you will draft this brand, that what exactly is the risk and why exactly is it a risk. So with respect to the risk of material misstatement, all that you need to think is what could go wrong with the financial statement. All that you need to think is what could go wrong with the financial statement. Let's move forward. If there are any queries with respect to this question, please ask right now, or then I can actually move forward. No, you don't have to name the accounting standard. If you are not going to discuss the accounting treatment, then how will you actually highlight the risk? Because the risk is that the accounting treatment is not being followed. That's the biggest risk. Wrong calculation of amortization, that is okay. Due to rapid change environment, new products are introduced and old product sale become decline. Yes, Qasim, that is also a risk. But you see, what you should do is that you should try to identify only the evident risk. I mean, you see, there are a lot of evident risk already, so why do you need to develop new risk? No, you don't have to refer them. If you have identified a risk pertaining to a brand, you have to actually connect it. You have to actually write down the risk relating to one specific matter together. No, you don't have to define, because the business risk was a different area, different thing. And similarly, okay, Rabia, your question is, do we have to define business risk or ROMM before evaluating scenario? You can do it. You can afford to. You can opt to do it. It's not mandatory. Daud, you have identified IS 41. One thing is that IS 41 applies to agriculture. IS 41 applies to biological asset. You are developing intangible. You don't have biological asset over here. So my request to all of you is going to be that don't try to actually write down whatever you know. Just try to write down whatever that is needed. So like if you can actually pick that animal health refers to IS 41, that's not relevant in this scenario. Okay, Faris, I'm going to come on to your question about audit risk and ROMM to be same. Rimsha, I will bring it. Hamid, there is no such thing as how many lines is needed. It's just that you need to explain it. Sadullah Khan, I don't have sufficient time that I can revise all the accounting standard because the main objective is to familiarize you with the way to handle the paper. Jazib, drafting is the problem. That's what I'm trying to do. Yes, Hain, we need to calculate the materiality, but the biggest problem with here is that you don't have the numbers available. But I would actually connect it to one or two things. Okay, there is something that I would want to identify and highlight, which Hain actually referred, which is if you go through this question, you would figure out, in this question, you would actually figure out that you would figure out in this question that there was a claim of 3 million available, there was a brand of $5 million that was acquired. So if you calculate this $5 million, which is a brand, divided by the total assets which are given in the balance sheet. Do we have the total assets? Yes, we do have the total assets. So we do have the total assets, which is actually 200 million. So you would say 5 million divided by 200 million. So you will end up getting the materiality of this brand. So it's always good that whenever you have the number available, you calculate the materiality because it enhances the marks. It gives you more marks. In order to ease up the situation, what I will do is that I will, in fact, no. Anyways, let's continue with this. So we have actually discussed about this scenario, which is identify and explain 4 risks of material misstatement to be considered in planning the audit. Now the next situation that arises is there is a third requirement to this question. And what is that third requirement to the question? The third requirement to the question is, it says recommend the principal audit procedures to be performed in respect of the acquired cold comfort brand name. It says recommend the principal audit procedures to be performed in respect of the acquired cold comfort brand. Now let's just try to discuss about these audit procedures. You see, we have discussed up till now that what exactly is the risk of material misstatement. We have discussed about it, and we also do know that what exactly are the business risks. So all that we need to do now is that the third requirement of the question is that you need to apply the audit procedures with respect to this cold comfort brand names acquisition. So I'm going to discuss a bit about the audit procedures, that what exactly are the audit procedures all about, and how do we develop the audit procedures, what is the method, what is the approach of doing it. So you try to understand one thing, that whenever we are doing audit, whenever we are performing audit, so while performing the audit, the first thing is you need to identify the risk of material misstatement or the audit risk. Now what is this risk of material misstatement or the audit risk? It's basically we think what could go wrong. We think what could go wrong. Now a lot of students actually face a lot of difficulty in identifying in developing the audit procedures. So I'm going to guide you about a very easy way of developing the audit procedures. So the first step of any audit is to assess the risk of material misstatement, which is to identify the risk. Once you have identified the risk, then what happens is the next step is about the substantive testing, which is when we try to gather the audit evidence by performing the audit procedures. We try to gather the audit evidence by performing the audit procedures. Now, what exactly do we mean by performing the audit procedures? So let's just talk about it. When we perform the audit procedures, so what we try to figure out in the audit procedure is we actually check if something has gone wrong. We check if something has gone wrong. Now, it's connected. If you want to identify the risk of material misstatement or the audit risk, you need to think what could go wrong. You need to think what could go wrong. And once you have thought what could go wrong, then you need to check, has something gone wrong? Now, when we say audit procedures, so the audit procedures are to check if something has gone wrong. I could actually identify the various types of audit procedures. I generally remember, or I generally ask students to remember the audit procedure using this mnemonic, which is AEI square OU, the vowels, which is AEI square OU. Now, what is this AEI square OU? So, A is about analytical procedures. The E is the external confirmation. I is inquiry. I is inspection. O is about observation. And when we talk about U, so it mainly is there for the recalculation. Now let's just talk about it. So analytical procedures, external confirmations, inquiry, inspection, observations, and recalculations. These are the various audit procedures that we perform to check if something has gone wrong. Now, if I talk about this specific scenario, I would try to explain to you people that how we would be able to develop the audit procedures. And remember one thing, it's not a very difficult task to develop audit procedure. It's just that we have made it difficult. It's just that we think that it's difficult. It's not difficult at all. So the question's exam requirement is, recommend the principal audit procedures to be performed in respect of the acquired Cold Comfort's brand name. Now, the question's requirement is of 5 marks. So that means I would say 1 mark per point. I would say 1 mark per point. Now let's just talk about it. If I say 1 mark per point, so I will start discussing it. Let's just discuss. First of all, I would ask you people to identify the risk pertaining to this Cold Comfort brand name. That is risk. You need to think what could go wrong. Take a minute or so and we will discuss. So you need to think what could go wrong with respect to this brand. I'm going to answer questions raised by every one of you. Just wait for a while. I'm going to answer every single question. Okay, now see, what are the risks? When we look at this Cold Comfort brand name, so the risk pertaining to the Cold Comfort brand name is, It says another success in 2014 was the acquisition of Cold Comfort's brand from a rival company. Products to alleviate the symptoms of coughs and cold are sold under this brand. The brand costs $5 million and is being amortized over an estimated life of 15 years. Now, number one of them is basically the brand is a non-current asset. So you could actually think about various things, see how the accounting goes. Number one of them is recognition. Number two is measurement, which is initial measurement and then subsequent measurement. That is how the accounting treatment is. So now, one of them is the first risk that I would highlight, or the first risk that I would identify is, I would say, that the number one risk is about the the entity does not have title to the brand. There is no title. The entity has not acquired this brand. That's one of the risks. Number two risk is that the cost of the brand was not $5 million. The cost of the brand was not $5 million. The third risk is basically it's the useful life estimate of 15 years is incorrect. Another question, another basically risk. So we have got another risk, which is the useful life estimate is an incorrect estimate. And we need to also think that the full year amortization is charged. Full year amortization is charged. Full year amortization is charged. So now, you see, you need to think what could go wrong. What could go wrong? Where could the entity make an error? What could go wrong in the financials? Now, once we have identified these various risks, which is there is no title. Number two, the cost is not 5 million. The third one of them is useful life estimate is incorrect. Number fourth is the full year amortization is charged. Now see, so what would happen is your audit procedure would be to test if something has gone wrong. Now how would I test? I would inspect the title deed of brand. So when I will inspect the title deed of the brand to confirm ownership. You see, this is one of the audit procedures that you performed. You identified the risk, that the risk is that the entity does not hold title to this. And then what you did was, you said that I would inspect whether the title belongs to the entity or not. Number one, to confirm the ownership. Now, a very important point is when you write the audit procedure, you have to tell that what exactly are you doing and why. You have to tell that what exactly are you doing and why. So inspect the title deed of the brand to confirm the ownership. That's number one. Number two is that the cost of 5 million. So the 5 million's cost could be verified from inspect purchase agreement to confirm cost of $5 million. Number three, useful life estimate. In fact, what you could do with respect to $5 million is also you could trace payment of $5 million from bank statement. You could also trace the payment of $5 million from the bank statement. And then we have got a useful life estimate. And what is this useful life estimate? You could actually perform the procedure of obtaining the written representation. Usually whenever the estimates are involved, one of the best audit procedure is what you do is you obtain written representation. You obtain written representation from management that what makes them estimate useful life to be 15 years. And you could actually recalculate amortization expense recognized in financial statements. You could recalculate the amortization expense recognized in the financial statements. So you see, this is how you actually try to identify the audit procedures. You develop, you don't have to rote learn. You don't have to rote learn these procedures. It's just that more of an application. You need to think what could go wrong, and then you actually test if something has gone wrong. That's how the audit procedure is made. Yeah, you could review the disclosure also. You are welcome, Anchal. That's what the objective of the session is. Rabia, it will happen. No, you don't have to. You don't have to write the. You don't have to talk about the ROMM. You don't have to talk about. Okay. Anyways, what I am now gonna do is that I'm gonna answer the questions of various questions that are unanswered. I'm gonna answer those, and I'm gonna. I think since 8:30 we haven't actually discussed the answer. Okay, so our assumption about the risk have some weightage. Does assumption about the risk have some weightage? Wali, what do you want to ask? The next thing is, Daud, you are done. Is it necessary to mention accounting standard? No, it's not necessary to mention accounting standard. Then the third thing is, I was unable to identify business risk in December 16. ACCA, what I will do is that I would try to do one more question on the last day on the business risk. But the simple thing is, you just need to think how the business could be adversely affected. It could be because of your competitive position, could be the market, could be your financial health, could be anything. Wajiha, you don't have to memorize. I would strongly recommend that you try to develop the audit procedures, because then the things would become very easy. Yes, Rabia, this is good. Waqar Khan, whether the brand has been acquired or not. Okay, Sajid, what evidence about mnemonics? What is you in the mnemonic is recalculation. It's actually recalculation. Asghar, I hope that the audit evidence is done now and you don't have issues. In fact, the audit procedure is done now and you don't have issues, but I would actually go through more exam questions tomorrow and I will discuss more things. Abir, thank you for your compliment. And yeah, Rabia, we will surely spend more time. Ahmed, yes. Achal, you're welcome. Ahmed Moti, yes, since this question is asking about procedures. Do we still need to talk about? No, you don't have to. If one risk is repeated several times, okay, there is no negative marking in ACCA. All that is there is positive marking. The only thing that you need to consider is that you should not be wasting your time by actually repeating the same thing. Yes, the board minutes, Farwa, yes, the board minutes could also be reviewed to confirm that because you see every single non-current asset purchase decision should be approved by the board, non-current asset exceeding a specific threshold. SN usually procedure means an action, so obviously you will start it off with a verb. Bilal, inherent control and detection risk is something we'll cover up tomorrow in the audit risk area. So right now I had this question of ROMM. I just wanted to develop the capability of you people to develop the audit procedures, to understand the business risk, to deal the scenario. Okay, Rabia, we will ask them to send across an email. Queen Mary, it's okay, you write the definition, but just try to understand that the examiner is looking at big picture. Arfan, I mean, it's very sad to hear that you have failed this many times, but I would strongly recommend you people that you attend this webinar completely. And once we are done with this webinar, then you try to actually, just write down an answer to one question and get in touch with me. I would actually help you with this. You could also join the WhatsApp group. The link of that has been sent on this window. No, the goodwill cannot arise. Goodwill can only arise from the acquisition of the entity. Okay, Aksa, I will try to. Asad, you don't have to write. I mean, you see, if you identify multiple risks, you write down those multiple risks. External confirmation in the mnemonic, neglected by the examiner, sir. Okay, Jahadeb, I will try. General, I will try to share some. I will share a list of audit procedure. Don't worry, tomorrow or day after. Okay, Hen, you will get an email tomorrow. Wali, I think 37 marks shows that there is a weak knowledge. Yes, Ishfaq, don't worry, we will come on to the ethics. Can somebody post the WhatsApp link? I think I don't have the WhatsApp link available. Can somebody please post the WhatsApp link here again? Yes, Sumaya, group is going to happen tomorrow. Yes, sufficient enough. But you see, when you write the audit procedure, then you have to say that inspect the board minutes to confirm that the board authorized the acquisition of this asset. Asad, you can do it. Thank you, Taha, for posting this WhatsApp group. Anyone who wants to join can join, and I would try to actually respond. Can you please add another question related to this topic from past papers? Azib, you will get a summary related to the other questions, and I would give a list of every single topic just for which you could actually attempt the past paper. Rohan, your question is not clear. Please share me the cap of recognizing RMM. Okay, I get your point. It's actually all about actually thinking that what could go wrong with financials, and automatically you will start identifying. Yes, we will. I think that's it for today. Thank you very much, everybody, for joining us today. Um, yes, Wali, we will continue. Don't worry, it's just a start. It's just a start. The WhatsApp link has been posted again. I mean, I think Taha Kazi posted the WhatsApp link a while ago. Does we have to categorize? Okay. Um, yes, Rabia, what do you want to know? Rabia Khalid, please, could you write down what you want to know? Anas, I would try to do that. Anyways, thank you very much, everybody. Yes, you can get. Rabia, I will do that. Don't worry. From tomorrow onwards, I would actually start doing it. That is, I will assign a few questions to you from the revision kit, and so that you people can practice even when for the whole of the day. Yes, Tanzil, you can get the slide. No, it's not important. It's not necessary, Poonam. It's just that you need to make the. It's just that you need to give the desired answer. I mean, you need to address the requirement of the question. You don't have to write long answers. That's of no use. That's useless. Ishfaq, if you have registered with the ACCA, you will get it online. You register, you will get it. You will register, you will get everything from the ACCA. So risk of material misstatement, assertion level on profit and sales. Yes. Yes, Vajia, I will highlight few articles that you should go for. Don't worry about it. Well, the risk identification can be in bullets, but the point is you don't actually have to just identify the risk. You have to identify and you have to explain what is the risk, because the question requirement is evaluate the risk. So you see, if you try to identify, that's half a mark, and there is a maximum limit to that marks. Like it could be 4 mark, it could be 5 mark, it just can't be that out of the 15 mark question you identify a list of risk. You can't go about like that. So you need to actually ensure that you identify uh, Rarvin, my suggestion to you would be that just attend this webinar, and during this webinar you will get to hear a lot of things from me, that how to write down the short answers and etc. Thanks, Poonam. Thank you, everybody. Let's meet up tomorrow, and I would try to actually make it more. I would try to actually make it more informative, and I can understand that you people need me to share a few things like suggested questions and list that. So I would do that. Adnan, business risk create the audit risk. The next step is financial statement risk. Okay, so the new name for the financial statement risk is risk of material misstatement, and the business risk lead to the risk of material misstatement. Rimsha, the webinar is going to last till 28th, which is Friday, and then Saturday is a mock debrief. Hassan, which link are you talking about? You will have to probably open it up from your mobile phone. That's a better approach. Tomorrow we will continue it. We will actually go for group audit. We'll go for finalization, and we'll go for audit reporting. Adnan, the risk of material misstatement and the audit risk, the only difference between them is the detection risk. The audit risk is actually detection risk, inherent risk, and control risk, and the risk of material misstatement is inherent risk and control risk only. Okay, Hassan, you send across your number. I'll try to add you to it. I think it will become very difficult for me to add up everybody. I would suggest that you follow the link, because it's not easy for me to actually write down the numbers and out. If there is any issue, I will share the group link again. But I can't add. I'm sorry, I can't add everybody. Anyways, thank you very much, everybody. We are gonna focus upon the group. We are gonna focus upon the group audit tomorrow, and we are also gonna focus upon the other areas. So I'm hoping that hopefully we would be able to have another fruitful session tomorrow. Rimsha, it's all gonna open. It's all gonna open through the WhatsApp on the mobile phone. You're welcome, Adnan. Thank you. Thank you, everybody.